50% of the taxpayers paid 97.7% of the tax. So that means the lower 50% only paid 2.3% of the tax.
Unbelievable.
So
that's not an equitable distribution, in my opinion.
It's not. It's not.
Need some advice, never sacrifice, always get it right. Ask the plan man. Finance, insurance, and more.
Everybody, welcome back to Ask the Plan Man. I'm your host, Bruce Weinstein, and as you know, I have this strong belief that everybody needs to be proactive, needs to have a plan with every aspect of their lives, especially in their financial world. Today, I'm being joined by a buddy of mine, Dwight Dye out of Murfreesboro, Tennessee, who I've met several years ago through Coach Bird and the coaching programs there. Dwight is the owner of DWD Tax Strategies, and he and I have been talking offline for the last couple of weeks about these proposed changes by the Democratic Party to the capital gains rates and overall tax rates, which, of course, you know, if you understand fiscal policies, Democrats are more tax and spend. Republicans are a little friendlier in corporate tax and the tax rates. And we'll go back to the Reagan era of, you know, trickle down and let you have more money and put that money to work and have more economic expansion. So, Dwight, welcome to the show. You posted something the other day. Let's start with that. Let's talk about these proposed changes. Let's tell a listener where we're at today and what these proposed changes that the Democratic Party are proposing for 2025.
Well, thanks, Bruce. Thanks for having me on. A longtime viewer, first-time guest. So I appreciate you having me on and participate.
Absolutely.
The post you're referring to that grabbed so much attention was Kamala Harris's proposal for changing the long-term capital gains rate. Currently, it's at 20%. That's the max you would pay on long-term capital gains. And when you add the alternative investment, the net income investment tax of 3.8, the most you're going to pay is 23.8% when you sell a long-term investment. But she basically
plus state.
Well, yeah, I forget state.
Yeah.
You're in Florida. I'm in Tennessee, so it's easy to forget state taxes. So,
right.
Yeah, if you have a state tax, it's going to be even higher.
I fled New Jersey because of the state taxes. So,
well, we've experienced an influx of people from California, New York, New Jersey, here in the Middle Tennessee area because they're escaping too. But if you had a choice, I think Tennessee or Florida would be good options either way.
Yeah. There's about 4 or 5 states, I think state of Washington, Texas, Tennessee, Florida, like become the big havens for at least getting rid of state. Let me give a quick story on that, and I'll let you keep going. So back in 08 and 09, when the market crashed, I took sizable losses as everybody else, and I reported $400,000 of capital losses. Okay, I'm not trying to impress with big numbers because money's long, long gone. But the next year, I made back my $400,000. So, you know, I took the gains, market bounced, eventually made it back in 2009. And federally, you get that rollover, you get the carry forwards where I got most of that offset. I didn't pay any federal tax on those capital gains because the year before carried forward. Except in New Jersey. New Jersey is a cash balance state. New Jersey says you owe us $40,000 for those capital gains. And I'm like, what? My accountant's like, yeah, it's a cash balance. Like they don't carry forward. So I lose 400 grand. I make back the same 400 grand. I'm barely even Steven. And I got to give the state of New Jersey $40,000 for making my own money back. That was the day I plotted to start leaving New Jersey. So go ahead, Dwight.
Well, in that case, is there with the $400,000 loss, did New Jersey allow you to take that in 1 year, or did they make you spread that out? Do you remember?
No spread out. It's use it or lose it, and it wasn't like I had things to offset it. So, you know, you only get back what you pay in, right? So it's not like I got the benefit of a $400,000 loss that saved me a gazillion dollars, but my point is the next year, all I did was make back what I lost. I didn't all of a sudden have a new $400,000 net worth. I barely got back to even. And to have to write a check for $40,000 well, not even am I? I'm still upside down now, paying them their tax. So it was just a ridiculous policy to me that I had learned the hard way. And at that point in 2009, I'm like, the sooner I get out of here, the better. Forget my property tax and all the other, say all the other taxes in there. But New Jersey and New York are two of the highest tax states, and the top income bracket hits 10% in New Jersey. So it starts in the 3 and the 4s, but quickly escalates. So to your point, where capital gains, I'll bring it back in. The capital gains is 20% in New Jersey, depending on how much you're making. It's another 4 or 5% on top of that. So now, if she's proposing going to 45%, and those people who have state tax due, they're going to give half their money away. What's going to be the incentive for somebody to want to take the risk to invest in something and then say, "Oh, I got a silent partner they take no risk with me, and they're going to take half my profit." Hey, Dwight, I'm going to invest in your business. You go do your thing, and whatever you make, just keep giving me half, Dwight. You're going to be like, Bruce, go scratch your ass.
Not a good deal. And to your point about the capital loss, there's a lot of our numbers that have been the same for years and haven't been adjusted for inflation. And the most you can deduct, assuming you don't have any capital gains to go against a capital loss, is $3,000 a year. Well, if you've got a $400,000 loss with no gain to go against it, that's going to take a while at $3,000 a year to go through that.
Right. If thank goodness I put money to, I had money to put to work and made it back quickly, but 100%. What are we talking? 300 years to get my money back? Like, come on, it's like insane.
Something like that. But yeah, the proposal it's 44.6. To be accurate. It's like, where'd you come up with the 0.6? Why is it 44? Why is it 45? Just like the proposal is to raise the top marginal rate to 39.6. And I guess it's like that old sales,
right,
strategy.
99 cents.
Right. 19.99 versus $20.
Yeah. No, it's crazy. Now, is it, I haven't read too deep in it. Is kind of a like the tax rate goes up marginally? Is it just going to jump straight from 20 to 45? Is it going to be based on income levels or amount of profits, or is it just straight like from $1 to infinity? Every penny is going to be 44.6, or is it phased in a little bit based on either what they make or what their income levels are?
Yeah, it's my understanding that it's going to stay phased the way it currently is. So depending on your income and depending on your capital gains, you could actually pay zero in capital gains tax itself.
Right.
And it goes zero today. So right. 0 to 10 to 15 to 20. Right. It's staggered depending on your income level. So it's my understanding it will stay the same. It's just that top 20% now goes to 44.6, which doubles it. Now, between 0 and 44%, or 44.6, I don't know if they're going to add in other thresholds where you'll pay, maybe a smaller tax instead of the 10 or 15. Maybe those go to 20. But, from a tax planning, I help people with tax planning. And, a lot of times we're looking at investments, whether we're going to pay short-term capital gains, which is just taxed at your normal ordinary income rate, or, if we hold this for another month, it's going to qualify as a long-term gain, and you're going to save money. Maybe you're in the 35% bracket, and just by waiting another month to sell, you're going to save 15% in taxes.
So, and again, let's just educate. So long-term capital gains is considered a year and a day.
Yeah, it's more than a year is technically the way it's worded. So 366 days.
Right. So if you bought something on January 1st and you sell it December 31st, you're still going to be considered short-term capital gains, folks. That's going to go as what they call normal income. It'll be taxed whatever your income bracket is at the highest level. So it phases in. If you hold it those 2 extra days, as Dwight's sharing, you then fall into the capital gain, long-term capital gains rate. And then again, depending on your income, it could be 0 if you're in a lower income bracket, 5, 10, 15, 20%, tops out at 20. But it's advantageous. And I think part of the big problem is a lot of people are, let's say, day trading more and more. They're not in it for longevity as much as I'm trading crypto, or I'm playing stock options, or Nvidia's earnings are coming out and I'm getting in and I'm getting out. I'm gonna grab that quick run. And so, all of that's moot. I think the targeting that we really want to delve this is going after the bigger money, the corporate money, the mutual funds. Like this is the long-term investor. Maybe the individuals do it if they have financial advisors, but mutual funds and hedge funds invest with long-term 3, 5, 7, 10-year horizons. Warren Buffett rarely sells. And so they're sitting on massive amounts of long-term capital gains, which bodes the second item on our checklist we want to talk about is this proposal for taxing unrealized capital gains. So again, what does that mean to the new listener? Unrealized means I'm sitting on something that I paid $1. It's now $5, but I don't want to sell it. I think it's going to go to 10. It's going to go to 20. But if it went from 1 to 5, I've got $4. I've made 400%. That's an unrealized gain. So I see that nice fat profit and I'm all excited and, but now all of a sudden they want to tax you on something you haven't even accepted. It's on paper. It's like saying, Dwight, your house just went from 500,000 to $1 million. You owe us $200,000. And then your house goes back down to 500,000. You're like, why did I give you $200,000? So explain that. How's that supposed to work? Like
Well, I think it just gives you a real insight into the thinking of the Democrat Party and how the stuff that we own and that we've worked so hard for, that we've taken risk to invest in, really, we're not capable to handle that. It's just best to turn that over to the government and let them disperse it as they see fit. It's very problematic. Like you're saying, I'm paying a tax on something I haven't sold, so I don't have the money to pay the tax. Okay, so now I go and sell something to pay the tax, but now I've got more taxable income.
Right. So I turned it into an unrealized at 25%, into a realized at 45%. Like, well, wait a minute. Like, it's I don't want to say reckless. It's just ridiculous. It's a ridiculous.
Well, and like you said, I could own these stocks or whatever I have as the investment, but then at whatever the cutoff day for the value is, the very next day it go down. Right. But I don't get there's no workaround for that. Okay. I now have it's now worth less than what I just got taxed on.
Right. Real quick, so. I'm doing this since '86, right? And so I went through the .com boom and bust, right, from the late '90s into the early 2000s, and a lot of people that worked for Cisco and Intel and Sun Microsystems and Lucent, and those are the hot names in the day, Yahoo, AOL. They were awarded stock and stock options. And a lot of that created phantom income tax based on how those awards were generated and created. And so they were taxed on receiving these grants, these stock options. And then when the bubble burst, they lost all of that money and they were so upside down, but yet they still owed the tax on something that was given to them at $100 that went to $5. And so to me, this is like a precursor of that all over again. It's like, we tried this one. Like you tax people on phantom income and then the asset disappears. And good luck trying to recover it. They're not going to give you your tax back. You paid that tax, that door's closed. And now the next year you go to sell your Cisco stock. And we had a client way back. Her tax people, she had a $600,000 unrealized capital gain in her Cisco stock. And we're like, look, you got to take some profits there. You got to diversify. Like that's a pretty sizable amount of your money hanging on one vehicle. And, the basic rule is no more than 4% of your money in any one stock. And clearly this was her significant net worth. And fortunate, fortuitous that she made it, right? Or had it potentially made. Well, as much as we told her to diversify, her tax person said, you don't want to pay the taxes on all of that. Don't sell it. And that was 1999. In 2000, her $600,000 disappeared because the stock dropped, and now she had no $600,000. And so I'm not taking a shot at you as the tax advisor as much as what we tell clients all the time is don't let taxes and commissions get in the way of taking and securing profits. People are like, oh, I don't want to pay the commission. I don't want to pay the tax. I'd rather pay the tax at 30% than watch 100% of my profit disappear. So I just want to get that quick story in because it's all of 25 years ago, but again, it just rings true today.
Well, when somebody's looking at a sizable gain like that, I'll speak for myself. I have access to tax strategies that will help offset that gain and be able to keep more money in their pocket. So, it's probably just some bad advice, from an accountant, many years ago, that was probably, thought they were helping, but, ended up giving very bad advice.
Well, and your point is it's only as good as the people you surround yourself with. And look, in fairness, they may have exhausted any other offsets they had, but, there is a limit. It's not limitless on what you can do. But again, to the point, it was just she listened and didn't take, look, sell a third, sell half, sell 25%, but she sold none and then watched it all evaporate. And then we know what happened for the next decade. Those stocks did nothing. And so it was gone. And if it was an option, the option expires. So it was kind of crazy.
And maybe that was their plan, with it going to zero. Now there's no tax issue.
Well, I could have done a lot with that 600,000, pay a third in tax and have 400,000 to put in. Again, this is 25 years ago. Imagine what that 400,000 would be worth if she was prudently investing it somewhere, right? So what are you hearing about corporate tax and any changes? Did they talk about anything there? Because that was the big bug from Obama. And I want to get into some of that because look, folks, the reason we're doing this is understanding how this fiscal policy works and plays out because, there's an old joke. I don't know if you ever heard this is, Dwight, what's the difference between recession and depression? And you don't have to answer. It's rhetorical. So the answer is recession's when my neighbor's unemployed and depression is when I'm unemployed.
Okay. Yeah.
Okay. And what I mean by that is as long as it's not on my lawn, it don't matter. And so people don't care until it impacts them. And so you might say, hey, 45% tax rates, I'm not in that world. It's not going to impact me. And so you have recession behavior, like it ain't my problem. Well, the reality is it is because it impacts so much more that it does become your problem and it does show up at your doorstep. And I wanted to make sure we covered this. So back when Obama was in, we had very high corporate tax rates, probably 38%, 35%, you know better than I.
The highest in the world.
Highest ever. And so what happened was you had the likes of Amazon, Google, Apple, all the magnificent Mag 7 as they call them today. But think about those types of companies where they opened up branches, offices, headquarters in Ireland, in France, in England, and became offshore entities. So everything that Apple sold in Europe never came back to the United States. It was European sales, and it went through Ireland. They had massive buildings and headquarters, and they were accumulating war chests of billions of dollars that they were then redeploying in Europe and doing something else with. And it had no bearing of any of that money coming back in, what the term is repatriated. And one of the first things Trump did was lower the corporate tax rate and allowed billions of dollars from all of these companies to come back into the U.S. So when you want to talk about or credit how the stock market under Biden is at all-time highs, well, guess what? Apple stock is up. Apple stock, I don't know the exact numbers. Apple stock was $75 at its low in 2009, March of 2009. Apple is $225 plus or minus a few bucks and has split 28 for 1. 28 for 1. So people are millionaires having invested in Apple for the last 15 years, and you know how and why that was done, is because Apple's been buying back stock. Apple's been able to take that money and redeploy it instead of leaving it offshore. And so this is stuff that shows up at your doorstep. This is why your stocks are doing well in this economy, is because the companies have been able to use that capital back here and buy their own stock. And so people are just missing the understanding and the education that, tax the rich and tax corporations and pay their fair share. Like, it's exhausting. It's exhausting. So as far as I've heard, you've heard, no changes yet proposed on the corporate tax?
Well, when Biden had released his proposal, obviously he's not in the picture anymore. He was going to go from 21 to 28. And Kamala, one of the few things that has been released is that she wants to go on to 35 because 28 is not high enough.
Right.
So they're, again, almost doubling, what it currently is. Interesting fact about Google, I say fact, I heard it on the internet, so it's true, right? Yeah. That if you, instead of buying every iPhone that came out, if you would have taken that money and invested it in Apple stock with all the splits and things that you were talking about and the way the stock price has gone up, you would have $2 million. Can you believe that?
Yeah. No, it's
but people want to talk about, the greedy corporations not paying their fair share, where just as an investor,
created wealth.
You had the option not to buy the latest iPhone, but invest that money, and you could have, created wealth with it.
Right, $1,000 is worth. Yeah, I'm going to go down this rabbit hole because there's a couple points I want, and I'm going to give it back to you. So, this tax and spend and the blue states versus the red states, and the amount of handouts that are going on, and the destruction in these so-called blue cities, and Nordstrom's closing their doors and Walgreens closing their doors because you could steal up to $999 without being arrested. Like this is the policy. This is destruction. And so, I'm all about helping my fellow human being, but the party wants to take my money at high tax rates and continue to dispose it and distribute it to people who are not contributing to society, in my opinion, in these areas, and they're not working for the money. And so why do we keep giving handouts? I'm not talking about Medicare recipients and like those people paid for their Medicare benefits. I'm talking about people who don't work and collect unemployment or welfare or food stamps or other things. And I'm not talking about, new immigrants coming here and at least getting a head start, but I'm talking about the blight that sit in these inner cities that are allowed to continue to fester and get their handouts. And I want to share the story because I think it's telling. In 1980, my father and stepmother went to China. Nixon had opened up communications, and for the first time in decades, people were able to go to China. And my father went to China in the very early stages of when American citizens could go there. And they spent 3 weeks walking around China. And my father's walking around one day, and, they're in the old city names. Now they've all changed, but, Peking and Beijing, and a lot of them have changed. And he said, they love the parks. They love to go to the floral, whatever it's called. They go to the places where you can see flowers and all that stuff, right?
Or the gardens and stuff.
The gardens. I'm like, I'm getting old. And so all of a sudden, across the meadow, he's at this field. Across the meadow, literally 1,000 Chinese people congregate. And they're sitting there and they're watching us. And they get down on their hands and knees, all 1,000 of them spread out across the meadow. 1,000 people got on their hands and knees and pulled the blades of grass to mow the lawn. There were no lawnmowers. There was no aid or device. There was no scissors given to them. They literally spent, this is a communist country. You want your rice? You got to work for your rice. Okay. You want a piece of chicken? You got to work for it. So there's no handouts. You want something? What are you going to give back to society? And they made these people, their job was to get on their hands and knees for 8 hours and pull the grass. And obviously I'm passionate to this story 40 some years later, my father telling me that story when he went there. And I'm like, this country don't make you pull the grass. They don't make you clean the toilets. They don't make you do something to give back for the money we're giving you. We just keep giving it. And so they want to tax you and I who bust our ass, work hard, and all they want to do is keep taking more of what I make to distribute it to other people. And that's why I just can't be a fiscal democratic supporter. I'm a fiscal Republican. I'm a social democrat. I put my cards on the table. I have a gay son. I'm about gay rights. I don't care what people do. Stay out of my business. But don't tell me stay out of my pocket. Stay out of my business, out of my pocket. Like the government's gone so askew. The parties are so far divided. I'm 61 years of age. I'm an old man in the world, in the system now. And I'm like, what happened to this country? We're so far. I'm trying not to be political. I've been agnostically political. I'm get off my lawn guy. I'm just really agitated today. I've warned you coming in. It just seems, what's the end game? What are they trying to accomplish? Because it's communistic. It's socialistic. I'll get into the health insurance, but I know you wanted to share a couple of tips. So let me get off my high horse here a little bit. But it's just been so frustrating to me as I listen to these things go on, and I scratch my head of like, where are we going? Right? So let me shut up. Go ahead. Give the audience something. Calm me down. Calm me down, Dwight. Calm me down.
Count to 10 while I'm talking. Deep breaths. No, there's a lot to unpack there, though, Bruce. One interesting stat, just for the viewers, is the IRS is always behind on their data. So the most recent data we have access to right now is from 2021. 50% of the taxpayers paid 97.7% of the tax.
50%.
50% of the taxpayers paid 97.7% of the tax. So that means the lower 50% only paid 2.3% of the tax.
Unbelievable.
So
that's not an equitable distribution, in my opinion.
Yeah, that's not. It's not. Yeah. And that's why I don't think, a fair tax will ever pass, because half of the country has gotten used to not paying any tax virtually.
Right.
So and we've got the national debt just keeps getting run up. We have a lot of issues on hand, but to keep taxing that upper 50% and expect them to contribute more to fund that other 50%, that is creating a divide. There's animosity towards, the one group paying the tax. And it's similar to, when you were in school and they were running, the students were running for election at school, we'll give you free ice cream sandwiches on Fridays or, something like that.
Right. Vote for me.
With nothing expected in return. Coming out of COVID, the government pumped so much money into the economy that people have gotten used to not working. Pretty much anybody could qualify for unemployment. There was no making them go apply for 3 jobs a week or whatever the case may be. You just signed up and got it, for 18 months. And so that has set a bad precedence. Regardless of who that money is dispersed to, why are we sending it to Ukraine? Why are we sending it to other countries, but still taxing our citizens?
Right.
I've seen several posts too. If we have enough money to send to other countries, then you need to lower our taxes.
Right. We're the solution to the world. We're feeding the hungry everywhere else. We're not feeding our own hungry, or our veterans, or our homeless. And, you got to start at home. And again, it's a whole nother social, fiscal, conversation problem. But, at the end of the day, we're printing money. It's not like they actually have it. They just keep printing more of it, which then you and I pay later on the inflation side, which we're seeing this year more than ever, as interest rates have started to go up and inflation has been running rampant. But, when you say the 50%, it's a great stat. 97.7% of taxes are paid by the 50%. And here's the math. The political vote is a 50-50 split, right? It's not like it's a
Right.
60, it's not like the politics these days. It's 60% and it's 40%. It's 50.000 to 49.999. Like it's so tight between each side of where they're going. And it falls exactly in line to what you're talking about, because probably the top 50% of the taxpayers don't want to pay more taxes and they're going to vote red. And the bottom half are like, well, I like what I'm getting. I don't have to pay any taxes and I don't have to work and I'll keep voting blue. And then we open up the floodgates of the borders and they're bringing in more people to give more free money to at the top 50%'s burden. Well, eventually when they vote, where are they going? And so it's going to skew that. I mean, to me, that's the game. I think that's the point, right? And they're dumping them in cities that are going to stay heavy blue and vote blue. And man, I hate talking politics.
Well, it surprises me though, because on the left, on the Democrat side, there are wealthy people. So it's not a rich. You're one party or the other, or
Right.
wealthy.
No, clearly. Look, Trump was a Democrat until 2016, right? Like,
Right.
Bezos is a billionaire, Zuckerberg, like, these guys have been supporting the blue side, which you start to scratch your head in some of the sense because of the kind of money. But you know what? If I'm worth $400 billion and I got to pay a little bit more tax, but you and I look at it going, why pay more tax than you need to? Like, I've had Democratic clients with a lot of money and they're like, I make plenty. I'll pay my taxes. I'm like, bro, that's just not the answer. Like, my biggest client was worth $15 million and owned his business. And it took me years, decades to get him to do an estate plan. And this was before they raised the estate taxes. It was 600,000. It was $1.2 million. Uh-oh, lightning. I may lose power, folks. If it goes out, Dwight, we'll have to reconvene and figure it out. But like, he was so apathetic, he didn't care. And I'm like, don't you want your kids and your grandkids to get that money? Why would you not protect what you're legally allowed to protect and give $5 million, $8 million, $10 million away unnecessarily? And he shrugged his shoulders like, it didn't matter to him. And he was a very liberal Democrat, person. And and Jewish, and that's another, I'm Jewish. I don't think Dwight Dye is of the faith, but we don't need to know. But and I'm saying it because there's another talking point in here, because it has to do with Israel. It has to do with the Jewish anti-Semitism, that has come about. Jewish people, historically, the New York market has been very blue and very Democratic. I live in South Florida, and South Florida has been very blue for decades. And we had a red wave when Trump came in. We're a little more purple these days. But the Jewish person has a tough time looking in the mirror and continuing to vote Democrat based upon the leadership in the Democratic Party that are so anti-Semitic and now. And I talk with my friends and I'm like, how do you still vote? Forget the fiscal stuff. How do you vote for a party that is denouncing the existence of our people and of the state of Israel? So I want to get that out there, and I don't need to go down that rabbit hole. But again, it's all these things. Then you start going down the list of how you want to vote. You and I are not going to convince people, to change their points of view. But
Sure we will. Yeah, we will.
We're trying, right? We're trying, but they're gonna come back at us with their comments and their views and their distortions and what they think is reality. But the reality is, I see AOC and I see the Tlaibs and I see the far left side with the whole Palestinian support in Gaza and anti-Israel, and it's like, I don't, hold the phone right there. Like, I'm done. Like, I can't. As a Jewish person, I can't. It's hard. So I know you had a couple more points you want to get to. I still got one or two more, but go ahead. Take. I'm going to count to 10 again, Dwight. I'm getting hot.
Okay. All right. I can see some sweat coming.
You've never seen you watch my show. I don't get this animated on my shows, but man, this week's been rough for me.
Well, I was going to, you were mentioning, here recently, RFK has come over to the Republican side. Tulsi Gabbard, came over yesterday in an announcement. So some Democrats are starting to see, that the Democrat Party, the way it's currently trending,
right,
doesn't represent their values.
It's not JFK's Democrats, right? That's what they say. It's Robert Jr. saying, this is not my uncle and father's party anymore, and I can't trust what I'm getting. And it's so hypocritical. When Bernie Sanders sits up there and talks about equitable distribution, and Michelle Obama comes up there and talks about equitable distribution, it's like, last I checked, you guys have like 6 houses. You know, you buy an $8 million houses in Martha's Vineyard, like equitable distribution. Bernie Sanders is the world's biggest communist, and the guy's got 3 homes. He's worth millions of dollars. Like, dude, how do you look in the mirror and what are you smoking? Like, how are you expecting people to buy into this nonsense? And it's just, look, everybody's entitled to make their own, do their own thing, but don't talk out of both sides of your mouths and expect people to drink your Kool-Aid like it's. Go ahead.
Well, I didn't watch much of the convention, but I tuned in just to be educated enough and see who was speaking. And poor Bill Clinton, he would not be a Democrat today. Based on his views when he was in office, he would rely more on the Republican side, which is strange to say because I remember when he was in office, just thinking how loony he was with some things.
Right.
But now he's more. Yeah, he's more red. Same thing with Obama. I don't know that either of them could get elected as Democrats right now in the current climate. So that's kind of surprising.
Well, it's just like you said, how far left the party has gone to be, so whacked. So we wanted to talk a little bit more tax strategies. I want to talk about CPI a little bit, and I got a health insurance to tie in here too because of what's going on from the Democratic Party policies. But you had mentioned to me you wanted to talk about some tax strategies that you've been implementing a little bit different than what we've hit so far. So why don't I give you that platform a little bit, talk about that.
Yeah, and maybe I should have framed this at the beginning because when we talk about the tax system, and I like to reference Robert Kiyosaki's cash flow quadrant from Rich Dad, Poor Dad. That's a good framework on how our system currently works and kind of how this proposal for the capital gains tax increase kind of goes against that framework. And so currently right now, if you're a W-2 employee and a small business owner, meaning you file a Schedule C, the system really isn't set up for you from a tax standpoint because if you're an employee, you get a W-2, you just file your tax return, hoping your employer took out enough taxes during the year where you don't owe, or maybe you get a refund. Schedule C, you're going to file a lot of self-employment tax. So the other option then is to form your business as an S corp, where you kind of reduce some of that self-employment tax. And then below the big business is an investor. So the investor and the big businesses are the ones who benefit from our current tax system. The big businesses benefit because the government incentivizes them to employ people. That then they go and spend their money at Walmart. They buy stuff on Amazon. They go out to eat, and then they pay taxes on their W-2. And then you've got the investor who is investing in real estate, providing housing for people. We still have a big housing shortage in the U.S. So to raise the capital gains tax, that kind of goes against that investor tax incentive. To get back to the W-2, there's not a whole lot of tax strategies available for W-2 people because you're not on the right side of that quadrant.
Right.
You need to be the big business or the investor. So there is a tax strategy that I'm trying to get the word out on where W-2 people can benefit. And it's an equipment leasing strategy. And basically you start a business leasing equipment. The good thing is you start the business, but it's relatively hands-off. There is some participation that you have to do to get it to go against your active income. But there's a platform that I already have contacts with. They do all the heavy lifting for the person, and they buy the equipment. The equipment belongs to the individual, and then it's just rented through the third largest rental equipment company in the country. And the good thing is there's 2 ways to depreciate the equipment. You can either do Section 179 depreciation and take 100% of it up to about 1.2 million this year, or you can do bonus depreciation, which is only at 60% this year. So it gives some people flexibility. So if you're a W-2 earner, and let's just say that you made $500,000 on your W-2, well, you can buy $500,000 of equipment, depreciate that on Section 179, and wipe out that $500,000 of income.
Wow.
So now you have zero taxable income. the beauty of it is you personally aren't out of pocket $500,000. You only have to put 10% down. So I only have to put $50,000 down in order to buy $500,000 of equipment, but I can still deduct that full $500,000. And at $500,000, you're going to probably pay about $100,000 to $125,000 in taxes. So, okay, let's say that I've saved $100,000 in taxes. Well, I only had to spend 50. I still have another 50,000 in my pocket. Plus, I have assets that are being rented, and the average return on that investment is 18% over the course of a year. So, if you would have just gone ahead and paid your taxes, you'd get no return on your investment. The IRS isn't going to send you any money back for any interest.
Right.
So at least this way, on that 50,000 that you've invested, you're anticipated to get 18% return over the course of 5 to 6 years, and it's paid monthly. So it is an actual business that you participate in. But as long as there are some thresholds with your W-2 income, because the government doesn't want you. If you make $1 million of W-2 income, you can't wipe all that away. There's a excess business loss limitation. So this year it goes up to 610 if you're married, and it's half of that if you're single. So if you are married and you've got 700,000 of W-2 income, the most you could deduct in these losses are the 610.
Right.
But that still puts a huge dent in your tax liability. And I was on a call earlier today with a potential client, and she had a dilemma. She's like, well, I really like real estate, and there's a quadplex I want to buy, but I also want to do this strategy to help save money on taxes. Well, a lot of times people would just go ahead and buy that quadplex and then not have money to do this strategy. And I said, what you need to do is do this strategy.
Right. Do it the other way.
Then you've got the tax savings to go then buy that quadplex. And a lot of times people get that out of order,
right,
and then they don't have the liquid capital to offset their taxes with. And now they've got to come up with money to pay their taxes. So it's a huge strategy. It's perfectly legal. I mean, people can do this on their own. They can go buy equipment and lease it themselves. It's just now they've got to deal with the maintenance. They've got to market the company. Deal with the rentals, but this platform has it all set up where they just make the investment.
Right. You want to be more passive and hands off than what if I'm an engineer for a pharmaceutical, R&D company or something. What do I know about machine leasing and equipment? So you like any property manager for real estate, you want to have professionals that'll run it for you, right? So that sounds like that's what you're offering. You're talking about the quadplex and versus. So in 2009, 2010, 2011, my son was at Arizona State, and I started buying properties. They were 40 to 60% off of their highs, right? And $300,000 house was $1.25, $1.50, and I started buying some properties. And he lived into one and rented out to his friends, and basically created where he lived for free. And I was like, buy another property. And then ultimately, what happened is that the private equity world got involved and bought over 10,000 homes in the Phoenix market, and the competition for the short sales just blew up. But my point is, I couldn't, based on the income and being a W-2 person and not having any other tax strategies in notions, but any depreciation just got bucketed and saved until I sold the properties. Like I couldn't even use it in real time. And so where you're saying do the leasing over the real estate, people don't realize like maybe the real estate's not going to give them, if they're making a certain amount of money or how their income's currently derived, they can't even take that depreciation. Like my accountant's like, no, you can't write that off. You make too much money. And so it got banked. And when I sold the properties, I finally got the offsets, but no, in real time, it didn't do me any good. So your point of having this notion and idea of another solution is very important for the listener out there who's looking to find, look at your W-2, you can't do anything. And even when I was W-2, I couldn't write off expenses. If I took you out to lunch, there was no vehicle for that. And then if I had certain expenses, AMT sucked it back anyway. So it was just a black hole, and like it was ridiculous. So, W-2s are not anticipated by the government's eyes of having deductions for their business because you're an employee. Your business should be picking up those expenses. So the fact that I'm taking Dwight and his family out to dinner as my client, if XYZ company's not paying for it, I'm not supposed to be writing it off. Now, we're Schedule C, and I take all my expenses first, right? So I think I'm an S corp too. I don't know. I don't understand what I do. But I'm being told I'm doing the right thing. So listen, we're kind of hitting the clock. I had a couple more points. I think I'm gonna do a separate show on it, but let's recap. Is there any other ideas or no? I mean, I've calmed down a little bit.
You've calmed down. To your point about the real estate, once your income exceeds 150,000, you have to qualify for real estate professional status. And when you have a W-2, it's really hard to do because you have to meet a 750-hour requirement, and then more than half of your time has to be spent in that real estate activity.
Interesting. I'm learning.
So for me, if I'm sitting here doing taxes as my day job,
right,
I would have to also, however many hours I work on it, plus half an hour
right
in my real estate business. And it's really hard to do when you're a business owner outside of the real estate, trade. Yeah. It's easier for contractors, obviously, because they're already involved in real estate.
Sure.
But W-2 people, it's hard. You could do the short-term rental loophole where you could buy a short-term rental. The qualifications aren't as bad as real estate professional. But the government kind of makes it hard to, take those losses against your active income. But like you said, they do get suspended, and they fill up this bucket, that carries or that follows you year after year until you sell the property, and you can use them to help offset some gains at that point. So it's not like you don't lose them. They just keep adding up. But we're wanting to keep more money in people's pockets now.
Right. You want today.
Because you can do better with your money now, because if you wait 5 years to do something, you've missed 5 years of opportunity and compounding. So it's a whole lot better just to keep, and your dollar may even be worth less at that point.
Well, we know it is, right? Every day. But no, opportunity cost is real, taxes, inflation, and, who knows where we'll be in 5 years and what's going to change fiscally. And no, your point is valid. And so I would encourage anybody who's in a W-2 position and struggling to find ways to reduce some of their taxable income, talk to Dwight. Dwight, how can my listener find you, get a hold of you, talk to you? I'm sure there's no cost, at least for an initial consultation, right? So.
No, I prefer to go ahead and talk with people. There's no charge for the initial call. I want to see if I can help you. And maybe if I can't, at least give you something that you can do on your own, because I know that we can all do better with the money in our pocket. So if you want to schedule a call, people can go to dwd.dwightdye.com/contact.
That's a lot of info right there.
Yeah.
How about a phone number? You got a phone number? They can just call you.
Yeah, they can call me or text me. 803 is the area code, 417-1499.
Only because if they're listening, they're not writing down slashes and dots.
Or just follow me on social media, Facebook, Instagram.
Yeah,
it's just my name, Dwight Dye, and there's a scheduling link in all of those profiles. So
it's DYE, folks. So if you're not watching the episode, it's Dwight Dye, DYE. He and I are connected on social media, so you could certainly find him through me. Come anytime, ask the Plan Man, and I'll get you in touch with Dwight if you want more information. We'll put his info in the show notes if you happen to view it there. I didn't catch it if you're listening to it, but it's Dwight Dye, DWIGHT. DYE, it's DWD Tax Strategies, Murfreesboro, Tennessee. Folks, we've talked about a lot of things. I got more to talk about. I'm hot these days. I don't like where we're going. I'm speaking up. I used to be a repressed, agnostic, tax political person. I never spoke. I had clients on both sides of the party, and I always had to bite my tongue. But I'm in my 60s now, and I'm becoming the old cranky guy and get off my lawn, and I'm just going to speak up because I don't like where we're going. The future of this country is just going in the wrong direction. I'm one of the few people, I'm going to throw out one more name here, Ross Perot. You're a little bit You're old enough to know that name,
I
right?
remember Ross. Yeah.
So, Ross Perot ran, I think, in 1988 when Reagan was kind of ending his reign. And who came? He was running against, I guess, Bush, right?
Bush Sr.
Yeah. And not that I was a huge Republican in that day and age at, 25 years of age, but I appreciated being a young stockbroker, becoming a financial advisor in that window, in that era of the late 80s and the 90s. And I realized then, 36 years ago, our country's a business. Society runs off of economics and business. And Ross Perot back then had built his own billion-dollar, multi-billion-dollar company and was a successful, wealthy businessman. And it's the only time in my 61 years that I ever campaigned and volunteered in whatever those places are where people, help in their campaigning, those offices, right? So I drove to the next town and he had and I'm stuffing mailers, whatever I'm doing. But I just felt like the country needed to get away from politicians and put business people. And I'm not a fan of Trump. I never liked him as a person. I didn't watch what was his show?
The Apprentice.
The Apprentice. I would say The Associate. I'm all over the place. He screwed my brother-in-law on a personal basis. So up in New York. So I have animosity in that regard. I find him to be pompous. And as we see and why people don't like him is he speaks the truth and he's a little bit belligerent. But at the end of the day, I support the party and the fiscalness. And he's a businessman. You may not like him as a businessman. You not believe in the views of him as a businessman. He screwed my brother-in-law, out of money. And that's his tactics as a business bully, but he still got business savvy. And that's what he did his first reign and got this country back after the '08 nonsense and the housing crisis, which we don't have to get into Dodd-Frank and Barney Frank and all that, his cronies there and that nonsense of what happened in that window. But the country needs a proper fiscal ship. That's what I'm trying to get to, is the ship has to be maintained and righted. You don't want to be that yacht that capsized and killed the owner. The billionaire got killed because his ship wasn't right. His captain of his ship did not do their job, and a tornado hit them at 4 o'clock in the morning and capsized the boat, and he got trapped, and he and his 18-year-old daughter died, right? So you need the captain of the ship that's going to run it fiscally responsible. Otherwise, we're going to capsize. And we're going in that direction. Our debt is out of hand. Inflation's going up. Green, blue, red, whatever side of the aisle you're on. I'm hot because I just don't like where we're going. I don't know how fast it's going to implode and escalate to a head. But as you said earlier, money's going to Ukraine. $400 million in cash showed up on a plane under Obama and wound up in Iran. You can't support everybody if you're not. Dwight, if you can't pay your electric bill, are you going to give your kids their $5 allowance so they can go buy bubble gum? No, I can't pay my bills. I can't put food on the table, so I can't give money to somebody else until I fix my own ship. And all we keep doing is sending money overseas. How about we stop that for a while? How about we don't raise my taxes? How about we stop irresponsible spending? Let the machine work. Let economics grow. Let the corporations make their money. They're paying taxes. Please don't tell me they're not paying taxes. They pay taxes. Nothing else. They pay payroll taxes for the 100,000 people they employ. Those people get taxes and property tax. The system works. Mm-hmm. Don't monkey up the system and make it worse. You want to go back to the 60s and the 70s. You want to have, England used to have 95% tax. The Beatles have a song, The Tax Man. They used to pay 95% tax. Who wants to work when the government's getting 95%? And we're going to head there. We're going to be social. There's social health reform going on. The blue states don't even know what's going on because these products that I offer that are ending September 1st, the show it's going to be over by the time it comes out. But you have no options outside of Obamacare and group benefits in blue states. They don't allow it. And as of September 1st, the red states are losing access to alternatives in the healthcare area, which is impacting me, my business, and my clients. Again, this is another blue policy. Obama put it in. Trump took it out. Biden put it back in again. Depending on who wins the next election, the red states will no longer have options in health insurance outside of Obamacare. And Obamacare is 40, 50% higher for you, Dwight, if you don't get subsidies. And so you don't have private options in Tennessee like, well, you do now, and you're going to lose them. Texas, Florida, all the red states have access to private health insurance options that are going to be cut off next week, September 1st. So I just don't like where all this stuff's going. This is socialized reform. It don't work in Canada. It don't work in Europe. Why do you think they all keep coming to these countries? Nobody in Canada gets health care in Canada outside of some basic stuff. They all come to the U.S. because it's a 2-year wait. Oh, I'm sorry. You have lymphoma, Dwight? We'll see you in a year. What? I'm going to go to Sloan Kettering in New York. I'll pay out of pocket. No, the system don't work. But let's keep moving in that direction and make sure it doesn't work in this country and make it. It's not affordable. I'm ranting again. My health insurance on Obamacare at 61 years of age is $2,200 a month. $2,200 a month. I have an $8,000 deductible. I have a $9,000 max out of pocket. What am I getting for $40,000 some dollars? A free exam? I get my annual exam. If God forbid I have a major crisis, I'm out $2,200 a month. That's 26 grand. I got a deductible max out of pocket. I'm going to be out of pocket $35,000 before the insurance really pays for anything. It's catastrophic care. People, wake up. Now, if I made $30,000, my health insurance is free, Dwight. Who's paying that? Who's paying that? Now, what kind of lifestyle am I living if I'm only making $30,000? But now I got free health insurance. But if I make 100 grand, 150 grand, I'm supposed to spend 15, 18% of my income on just health insurance? Where are we going? What's happening? This is not affordable. It's breaking people's banks. We are an insurance heavy society. I didn't get into homeowners insurance and car insurance and life insurance and disability insurance. Like, we're drowning, folks. Fiscal policy's got to change. It's going in the wrong direction. And this episode, I'm hot because I just don't like where we're going. We could still go another hour, Dwight, with the issues I got on my list here, but we're going to wrap it up. So, all right, that was my last. I got more, but I'm going to stop here because I'm sure half the people like, this guy's gone off the rails. My shows are not like this. My producers will be like, yo, what's going on over here? Anyway, folks, I've been blessed to have my friend Dwight Dye join us today again. DWD Tax Strategies. He's in Murfreesboro, Tennessee. Great area. Love that area. I'm up there 2-3 times a year. So we'll definitely get together next time I'm up there. Folks, if you need some advice, always get it right. I hope I didn't turn you off. And if I did, I hope I ignited something in you. Go do your homework. Go do your research. Understand what fiscal policy is going on. Don't be the recession guy. Look at it as the depression guy. This stuff is coming up on your doorsteps. It will be depression. It won't be recession. It's not about your neighbor anymore. It's going to be about you. This is impacting you. And we want to make sure people understand fiscal responsibility, be the plan man, follow the plan man, be proactive, but you got to understand what's happening. Don't put your head in the sand. Don't be an ostrich. Dwight, any closing thoughts before I wrap it up?
Well, I know we started the show talking about the 44.6% and how that only really is going to affect people making a lot more money than the average day U.S. citizen. Keep in mind, when the U.S. tax system started, it was only to tax the rich and the wealthy. And then they got used to getting that money, and so they started taxing everybody. So it may start out taxing a higher income type person. Eventually, it's going to come back. It's going to come down to all of us. And regardless, if you personally pay the tax, we all are affected by these policies in one way or the other. If the business doesn't have the capital to hire employees, well, there's fewer jobs then. If the food is costing more, there's more money out of your pocket. So one way or the other, everybody is affected. And I like to control my own economy, worry about Dwight's household. And, I think this is they say this is the election. If we don't get this one right, then we're going to be doomed for years. They've been saying that, since Reagan was elected. And maybe before that, I wasn't alive, other than right I guess near Jimmy Carter. But I really feel like this is a turning point. And if we don't get this election correct, we're going to be doomed, and it'll be irreversible. So please make sure that you're thinking about a lot of things and do the right thing come November.
It's a slippery slope for sure. It's precarious. I'm concerned. You're concerned. I'm sure a lot of Americans are concerned. You don't have to be radical on the right side. Certainly, if you're radical on the left side, you're probably not even listening to my show, so it don't really matter. I'm not watching that Weinstein guy anyway, right? So anyway, Dwight, thank you again. Great to see you. I'll see you online, Facebook. Please go find Dwight. Find him through me. Find him directly. Again, folks, this has been a heated, emotional conversation with my buddy Dwight Dye today. I'm Bruce Weinstein. This is Ask the Plan Man. Please like, share, subscribe. I'm sure a couple of you might unsubscribe after today's rant, but it is what it is. I care about everybody. I want everybody to be better than where they were yesterday. That's what planning and proactivity is about. We're trying to give you sound advice and information so you can make the best educated decisions. I can't tell you what to do. I want to tell you about your blind spots. Dwight shared some blind spots. I shared some blind spots. It's up to you to take those corrective actions and be proactive. So until next time, we'll see you. If you need some advice, always get it right. Come ask the Plan Man. I'm Bruce Weinstein. See you next time.
When you need some advice, never sacrifice, always get it right. Ask the Plan Man. Finance, insurance, and more.